First of all, thank you so much, Emin, for joining us in this talk. The point of this talk is to talk about the future of crypto as money and everything that revolves around that. To start, Emin, for the people that don't know you yet, could you give us a short introduction of who you are, what your background is in crypto, and what your company Avalanche does?
Sure. Very briefly, until recently, I was a professor at Cornell University from 2000, at the end of the year 2000 until 2021. And in that time, I specialized in distributed systems as well as operating systems. I'm known as a builder, and back in 2002, I built the world's first currency that used proof of work for minting. It was a system called Karma. The year is kind of interesting for those of you who are a little confused about the date. It's really 2002 when it was built, 2003 when it was published, and that is 5 or 6 years before Satoshi. I did not pursue that. It's very well cited academically, but the timing was not right. It was right after 9/11, and it would have been untenable to build a system at that time and get funding for it. So I worked on other peer-to-peer issues. I worked on reputation systems, etc. And then I revisited that whole topic after Satoshi came along with a brilliant invention. He had one additional idea on top of the Karma idea that is absolutely a big breakthrough in distributed systems. And and his timing was impeccable. So after that, I worked on the security of Bitcoin. I worked on making sure that coins in cold storage are secure. I worked on decentralization, characterizing it, measuring it, and I worked on layer 2 protocols, built the world's fastest layer 2. I was involved in the DAO hack. I predicted some parts of it. I came very close to predicting, obviously, the very big portion of it as well. And most recently, I've been the CEO and founder of Avalanche, which is the system behind the Avalanche blockchain. And the Avalanche blockchain is the latest, greatest in consensus protocols. And by that, I mean it's the third biggest breakthrough in distributed systems and consensus protocols. And that's what I've been focusing on for the last few years.
Awesome. Thank you for that, Emin. I think everyone agrees that you're the perfect candidate to talk about what the future of crypto is going to look like, what's your background, with what you've been doing. So let's get into it. And I want to start by discussing Bitcoin a bit, especially Bitcoin as a currency. Because when we at Reserve, when we found Bitcoin initially, we thought the idea of non-sovereign money very attractive. We thought that was something that hasn't really been discovered before, at least not in the way that Satoshi did it. However, when we started researching it more, we kind of discovered, or we concluded that because of its limited supply, a relatively small supply, while it's being adopted, its price would have been really volatile. And that's what we're seeing now, right? The Bitcoin price goes up 50%, 50% up and down on a different date. And so we concluded that we don't think people are going to want to use Bitcoin as a means of payment, because we don't think for example, a store will want to accept a currency that might depreciate 50% in a day, nor will someone want to spend a currency if they think it might appreciate 50% in a day. So that's kind of our take on Bitcoin. And I'd love to hear, do you agree with our statement that Bitcoin cannot be used as a currency? And whatever your thoughts on that are, what do you think the role of Bitcoin is going to play, let's say in the next 10 years from now? Is it a currency? Is it gold? Is it digital real estate, like Saylor calls it? What do you think?
So Bitcoin started out as a medium for payments. And to really succeed at this, the initial vision for Bitcoin, one has to be able to do a few things. And some of these are technical and some of these are financial. On the technical side, the main thing that you have to do is scale. You have to be able to absorb all of the world's commerce. Now, that's a tall order. It's a lot of transactions per second. You have to be able to, at least to be a payment mechanism, you have to be able to compete with other dominant payment mechanisms. So Visa today achieves about 1,700 transactions per second. So if you want to be up there as widely recognized as Visa, let's say, well, you have to do at least 1,700 transactions per second. And Bitcoin cannot do that. That's one of the big strikes for why Bitcoin, the layer one, cannot be used in its raw form as a means of payment. Now, everybody, so this is not controversial. Every time I say anything against Bitcoin, people get up in arms, etc. This is something that anybody can look up and measure. And in fact, all of the technical people who work on Bitcoin will immediately admit this as well. So there are additional ways in which one could make it scale, these layer two solutions and so forth. We should talk about those separately, perhaps. But when you add a layer two solution, and it's required for your system to be able to achieve its core function, then you're in a funny world. You started out with X, and now you bolted on a Y, and your system is now X plus Y, right? It's like my car is no longer is not able to go fast, so I strapped a jet engine on top. Okay, but it's no longer a car. It's a combination. It's a weird vehicle. It's the Rube Goldberg machine of 4 wheels on the ground and a jet engine on top. So and for a variety of reasons that we can get into later, if you like, these layer two approaches have a bunch of drawbacks. So the privacy, the scalability, etc. issues of layer twos are unsolved. And I say this as the academic who I think did the most work, certainly the academic who built the fastest layer two. I can tell you that there are some fundamental problems with layer two approaches to scaling. So that's one. Your problem, I mean, your question was really about the value, the financial characteristics of the coin, and that's an interesting one. For a system to be used as money, you want its value to stay relatively constant. It needs to stay constant for the duration of a transaction. So if I take out some Bitcoin to pay you, if I take out, let's say, $100 worth of Bitcoin to pay you, and my transaction is going to take about an hour to get to you, well, that value needs to stay at exactly $100. Maybe it can go down by a cent, and maybe you won't mind, but actually you will. Like if I send you $100 worth at this hour, and you receive it in an hour, and it's down to $99.99, that's going to cause a bit of an issue for your bookkeeping, for your accounting. It's not really suitable. So the fact that Bitcoin takes so long to confirm, to finalize, means that its value has to be stable over that time frame, and it just isn't. Just is not. You can't really do, like, you don't know what's going to happen to the price of Bitcoin an hour from now, and an hour is an eternity. So what can you do? And in fact, I can actually one-up this a little bit as well. So not only does it have to remain constant for just the duration of the transaction being finalized, it also has to be constant for the receiving end to the payment. So if the receiver is going to take several hours to take that money and convert it to another form, etc., then the stability has to be over an even larger window. So what was the reaction? Well, I can tell you that in the early days of Bitcoin, people thought as adoption grew, the value will be more stable. So a Bitcoin maxi will say things like, oh, it's still the early days. You don't understand Bitcoin. So typically these maxis always start out by saying, you don't understand Bitcoin, as if they themselves have some magical understanding that I don't know where they got it from, probably listening to each other say random nonsensical things. But the claim was that as more people adopted and used Bitcoin, the value would become more stable. That's empirically not true. As adoption grew, Bitcoin's volatility reduced a tiny bit, but it's going sideways. For the last few years, the volatility of Bitcoin has not improved. Okay, so why is this? Well, there are a bunch of different dynamics at stake. And for technical reasons, Bitcoin ended up not being able to pursue the payments techniques, being a system for payments, like we discussed before. I mentioned again, the scalability is just not there. So what did it end up doing? It ended up going after the store of value narrative. Okay, so that's fine. You can do that. You can go compete with gold if you can't compete with the payment systems of the world. That's fine. And I wish it much luck. It's a much better form of value than anything else, right? So gold is just shiny and heavy and physical and hard to send around the world. So once you start competing with gold, that's fantastic. But what happens is people buy Bitcoin and take it out of circulation. And then the remainder of the money is then the remainder of the currency, the coin, is out there. So float is, there's a natural process that reduces float, and then that float, small float, leads to higher volatility. So at the end of the day, this is my little explanation for what's happening, perhaps. But at the end of the day, no matter how you dice it, we ought to be scientists. We ought to be able to start with basic observations, formulate thoughts, and invalidate them if the observations do not line up with narratives. Okay, so this is not a game just saying stuff. It's a game of saying things and then checking them with the real world. And the real world is speaking loud and clear. It says, this thing is not getting less volatile over time. So I agree with you 100%. It's not a good form of payment. It's not a good currency for the world to use in its current form. And I don't expect it to change.
Thank you so much for that, Emin. That was a great explanation. So you would say digital gold is the role of Bitcoin right now. Is that correct?
Absolutely. That's what it's going for. That's what all the devs are trying to build. That's what that's its role right now.
Okay, awesome. Let's dive a bit deeper into the currency aspect, because if not Bitcoin, and we still want to have a future where cryptocurrency is going to be, let's call it the future of money. Well, from our point of view, at Reserve, we think it needs to be a stablecoin. And so I want to dive a bit deeper into stablecoins, especially their designs, because I've studied the history of stablecoins a little bit, and to be honest, it is a little bit depressing if you look at what has happened. We've seen a lot of failed experiments, to be honest. A lot of stablecoins have lost their peg, the only thing that they really need to do. And while those failed experiments were still in the early days, while crypto adoption wasn't that large, I think that we can have some serious problems if the wrong stable currency gets adopted and becomes the future of money. Because let's say if a stable coin has billions in circulating value and then it depegs, I mean, it's disastrous, the effects that could be. So I want to discuss a bit of what experience do you have with different stable coins designs. What I mean by that is, for example, fully collateralized versus partial collateralized versus even algorithmic stablecoins. So question one is, what experience do you have in that? And let's imagine a stable currency of the future. What kind of design do you think it needs to have?
So let's see, what's my experience? I think all of my experience comes down to just being very early in the space. I've been around for a long time. I wrote with two others, with Kevin Seknicki and Amani Moin. Amani is now a doctor, has her PhD, and is working for the CFTC. Kevin Seknicki is the COO of Avalanche and also my co-founder at the company. So with the two of them, I wrote the world's first peer-reviewed paper on stablecoins. So that's my experience. We came up with a taxonomy for them. So these phrases that you use were mentioned in that paper. So I'm glad to see that everybody now has a common framework for being able to classify stablecoins. So that's sort of where I started from. We started taking a look at this space very, very early on. And just to sort of orient everybody, what do I think? So what does somebody who's a scientist think about the current crop of stable coins? Well, there are fully collateralized coins, the fiat-backed stable coins, right? So the tethers of the world, the circles of the world. These are technically very easy to understand, and they end up having a centralization problem and a counterparty risk problem. So there's an issuer, and the issuer needs to ensure that there is some backing on the other side. And as a user, you'd like to make sure that there's some backing on the other side. And it's hard to do unless you get some cooperation from the centralized issuer. They need to do audits. They need to reassure the public. That's a big problem. There are partially collateralized stablecoins. These are interesting. They have some other risks. They have chain risks. So that is when the value of the underlying partial collateral is dropping, then you may need to do things, and that's an issue, and the chain may not be. It's exactly in those times that the chain might be busiest. So if you try to build one of these on a limited capacity chain, you can get into situations. And then finally, algorithmic stablecoin are really interesting. They are truly, they really have nobody in there's no issuer, there's no centralization. You'll always have chain risk with them. That's always an issue. But there's a more fundamental soundness issue with them. Namely, these algorithmic stablecoins all rely on some kind of mechanism, some game theoretic mechanism, right? You end up having multiple coins, you trade one coin for another, etc. It's a bit difficult to get the game theory right. And it's like, if you read our paper, we say it really gently in that manner that academics say it in academic papers, but I'll be very blunt here. The game theory behind these things is completely unproven. It makes perfect sense when there's a lot of demand for the coin. If the universe is clamoring for DAI, let's say, then it's really easy to print more DAI, and the price of DAI is more than $1, then you print more. That's easy. That's the case where if you get lucky enough to be in that mode, you're fine. But if you end up going into the other direction, where the price of DAI is dropping, it's less than its peg, it has depegged, then getting the economics right is very, very complicated. And I haven't seen a study that I would consider sound. I haven't seen any proofs. I haven't seen a design that I would say, hey, I'm going to put all my retirement savings against this one. So I think those are incredibly risky, and we've seen it. We've seen these algorithmic stablecoins depeg and have all sorts of issues in the past. And we can go into what people do to make them not fail. I think a lot of the successful ones have had invisible market interventions by the people who created them to retain the peg. So it seems like it's an algorithmic stablecoin, but there is something in the background buying and selling to try to get the coin to go back into its happy zone. So at that point, that's not an algorithmic stablecoin. It's really a central bank managed asset. So I think it's been hard to design these things for good reasons, and I do love the whole idea. So I think it's really, really promising that perhaps we could come up with some automated mechanisms for designing these things. Perhaps we can automate away the task of a central bank, but we just don't know how at the moment. And so there I sit. So I think the fiat-backed currencies, those are, as I said, they're fine, but they come with a lot of drawbacks. And on the other side, the algorithmic ones, they're very cool, but I don't believe they're sound. At least I don't think that any of them have been shown to be sound. Some of them are more successful than others, at least empirically, but there is no proof that they will always be successful going into the future.
Wow, thank you about that for that, Emin. I think it's going to be an experiment, really, to find out that that ideal stablecoin. I'm not sure if anyone has really created just yet. Anyway, let's imagine a world where we do find that ideal stablecoin, and let's imagine that one stablecoin for just a second in a hypothetical situation, that one stablecoin is the best, and it's going to be the future of money. If you think of the world today versus the world, let's say 20 years from now, or even 50 years from now, just the world of the future, where crypto is a major thing in the financial system, how do you see the transition happening from what we have now, these traditional the traditional financial system, versus let's say in 50 years or 20 years, the crypto system? How do you see, so we have these legacy systems in the traditional financial system. How do you see them transitioning to crypto? Will they be accepting of that? Are they going to integrate that? Are they fully going to use CBDCs instead of private currencies? What are your thoughts on that? How do you see the transition to the future?
So first of all, when I think of crypto, I think of a range of assets. I don't just think of money. So I'll answer your question with respect to a range of assets that could be put on a blockchain. And what I think a lot of people have in their minds, what I think they've been fed, especially by Maxis, especially by some of the earlier people who started the space, is a vision that is just not workable. Okay, so it's not a practical vision. What's that vision? People think that a lot of people think that we'll wake up someday and we'll read in the news, NASDAQ has switched to a blockchain foundation. And, you can buy Apple stock on a blockchain. So I'm afraid to report that that's not going to happen. Okay, so if I know anything, I know this to be true, which is incumbents don't just give up their favorite position. People who have built moats after moat after moat, and they've had very specially constructed, complicated defense mechanisms for their business lines. They don't just give that up. So expect a huge battle when it comes to converting the existing world into a blockchain future. So we've seen this time and time again, and we're going to continue seeing this. So stocks and other things, they are not going to be on a blockchain the way a lot of people think. So how is this transition going to happen? Oh, okay, sorry. The other thing I should mention, I believe very strongly in a future where every valuable asset is on a blockchain. So 10 years from now, you'll be able to buy anything and everything using a blockchain foundation. So how do we get from here to there? Well, we get from here to there in a funny way. So here's what you do. Alternative assets. So assets that do not have an ecosystem of incumbents built around them are going to be issued on blockchains. That makes perfect sense. Look at, for example, the Roche Friedman law firm just issued something that they call initial litigation offerings on the Avalanche network. It's a new kind of asset. Nobody had done this before, and they just created a new token corresponding to the outcome of a lawsuit, and people can participate and support the lawsuit. And if there's an outcome, if there's a financial outcome, they participate in it. So it's a great new coin. Nobody's doing it. There are no incumbents. Of course, it's issued on a blockchain. That's a great idea, right? So there are many other assets like this that people will invent, and they will go to that system which is has the highest capacity and has the most flexible foundation. So they will get absorbed into systems of that kind. Now, what stands between us and that future? What stands between us and that future are a couple of things. We need definitely two things, but we need more. But I'll mention two. We need scale. I already alluded to this before. And we need flexibility. We need systems that can accommodate the various different constraints that come with different asset classes. So you can't just build one-size-fits-all systems. Okay. So take Ethereum, for example. It's a flexible system. You can program things, although its flexibility is hampered by the high gas fees you have to pay. But at the end of the day, you have a single system that is meant to be a good fit for the entire world. Now compare that to Avalanche. Avalanche has this notion of subnets, and it allows you to create smaller blockchain instances that have certain features that you determine. For example, you can say this. I'm going to create a subnet, and it's going to be governed by the laws of the United States. And suddenly you open that network up to assets that need to be governed by the laws of the United States. If an issuer has something valuable, but they say, hey, just because of laws, I can only convert this, let's say, debt instrument into something that's governed by the laws of the US, well, then they can do it on a subnet on Avalanche. You couldn't do that with a one-size-fits-all kind of a solution on Ethereum. So let's see. So that's going to be the transition path. And over time, what will happen is we'll see more and more alternative assets. Over time, we will see more and more projects fund themselves using business models that rely on coin issuance. That is to say, young, energetic people will start issuing coins when they start their project. That's exactly what we see today. The easiest way to tell the future is to observe what you're seeing right now. I'm seeing a lot of young, energetic people start their startup and issue tokens now. So fast forward 5-10 years from now, there will be a huge number of successful projects of this kind where instead of issuing stock or whatever else they would have done in an old traditional world, they actually issued coins, and the coins are an integral part of how they operate. And we will have more and more and more coins so as to essentially leave the traditional world behind. So just think about the excitement in crypto and compare it to, let's say, Facebook stock. It's just so boring, I guess, just so boring to trade one versus the other. And in fact, just look at what happened at Citadel recently. So Citadel, the traditional finance company, recently had an edict come from their CEO to the entire company saying you cannot use the company chat boards for discussing crypto. So this is really funny. I think their own people are realizing just how exciting this new universe is, just how much better it is than the boring stuff that they normally engage in. So that's going to grow. The only way that goes is to the right and up. Okay, and as adoption grows, as this area grows both technologically and financially, you're going to find that traditional finance world just starts looking at this with more and more envy, which is already happening. And at some point, when the value in crypto is roughly comparable to the value in TradFi, that's when you expect to have that switch over, patch over moment, where they say, okay, well, I think it's a lot easier, faster, better for us to put our assets not on these old traditional siloed platforms with very complicated rules, but on this other platform, or to migrate them somehow. So it's going to be a slower process. It's not going to come from the top down. It's not going to be overnight. It's going to be a growth process, starting with the fringe assets that are not well served or that are not well handled by the incumbents today, and then bleeding over to more traditional assets, and driven all the time by this push by new companies that are starting out as crypto native projects.
Awesome. I actually want to dive in a bit more into the hurdles you spoke of in that transition, because you mentioned scalability and flexibility, which make total sense for me. When I think of the future of crypto as money, I can think of another one that I don't know yet how it's going to turn out. And I want to give you a scenario. I want to share with you how I think about it, and I'd love to hear your thoughts on it. And the issue I see is with anonymous transactions. So to give some background, as you know, with the Reserve app, we do peer-to-peer transactions. So we do transactions, consumer transactions. People buy groceries, pay their bills, pay rent with the app. And I want to give you a scenario. So imagine that I am a store owner and you are a client or a customer. And let's say that we use some kind of crypto platform to transact, to make that purchase. If you're going to pay in my store, and if one of the main properties of blockchain is its transparency, everything is viewable via an explorer. However, if we're going to do that transaction that I was talking about, whenever you pay through crypto to me, I can check the explorer, I can check the blockchain, and I can not only know your wallet, but I can also see your wallet balance and the transactions that you've made, which at least in my mind is not where we need to go with consumer transactions. But then from the other perspective, so if you listen to that scenario, you might say, okay, well, we'll just make transactions anonymous or whatever. But then from the other perspective, obviously, we also need to be able to provide some transparency to mostly regulators, just because they need to make sure that there's no criminal activity going on. So I don't know, to be honest. I see two views, and I don't really know where the future is going to go. We at Reserve, we have some thoughts, but I'd love to hear, what do you think is going to happen? Are anonymous transactions going to be regulated out of existence, or do you see a future for them?
So first of all, I don't see anonymous transactions disappearing anytime soon. Why? Because they are unregulable. You cannot really ban encryption, and you cannot ban the use of cryptography in that fashion. So the regulators will never like them, but they're not going anywhere. They're not going away. So that's I don't want to make a normative statement, but if I were to actually take my scientist hat off and be myself for a second, that's wonderful. So why? Because we all need financial privacy, just like we all need privacy. So to be a real human online, you need privacy. And to be able to have actual economic transactions in the world, you need that to extend to the financial world as well. So I see a lot of innovation about to happen in that anonymous transaction space. It's a really exciting space from a techie perspective, but also it comes with risks. What risks does it come with? It comes with some societal risk. It can enable things to happen that we don't want to have happen. So what are those? Terrorists can be financed through anonymous transactions, and people can sell things that you don't want them to sell. But societies have every right to regulate certain kinds of behaviors. So I don't believe, I'm not one of these crazy people who says things like, oh, everything should be free, etc. I'm not. That's wrong. So but what's the right approach? So from my perspective, at least, I think law enforcement has to stop trying to regulate out of existence behaviors it does not want using the financial system. Okay, so they're just going to have to go do policing work the good old-fashioned way, and Lord knows that's easy, right? It's not as hard as one would think. I understand the temptation to say, look, you just may not do XYZ, and come up with very complicated rules to follow for financial transactions, and regulators will be very tempted to preserve these things. But from a tech perspective, they came from an era where we only knew how to build client-server systems, and they came from an era where we only had just a handful of these systems. When you go to the future, where anyone can build one of these things and they're truly unstoppable, well, then there is really no choice but to go back to proper policing, as opposed to trying to do the policing using the financial system. Move the enforcement elsewhere. And that's, I think, the right start to this entire process. And that's the right foundation, because you will need to have that policing capability anyway. So that's what I think about anonymous transactions. They're cool from a tech perspective. They do interesting things. They're super uncool from a societal perspective. Oh, and let's talk a little bit about regulators and their role. And the regulators play a crucial role in this, in enforcing the needs of the society on people who develop technologies. Now, the problem is that enforcement is really difficult with blockchain tech, and so we will also end up seeing technologies that make transactions private to everybody, but visible to regulators. I think that's also a welcome trade-off in this design game, and it's eminently possible. Again, on a flexible system like Avalanche, you can build these things any which way you like, and have solutions that have any property, whether it's full anonymity or partial anonymity of this kind, or whatever it is, pseudonymity. So I think there's going to be a lot of experimentation going forward. If there are any regulators listening to this, I hope they take away the idea that there are many techies out there who respect what they do and want to help them, but also realize that the tech itself is just ungovernable and unregulable, and therefore the regulators cannot just use the financial system to get what they want. They will have to do other things, such as do enforcement at the physical level as opposed to the financial system level.
Yeah, that makes sense. We also think it needs to be a hybrid. We need to be able to provide some anonymity to the users, but also some transparency to regulators. So we'll see how it turns out. I'm not sure yet. I'm sure there's going to be some solutions popping up very soon. There's one more thing, Emin, that I want to talk about, purely related to the currency side of this. I want to talk a bit about inflation. We at Reserve were super focused on inflation, mostly high inflation, hyperinflation in countries like Venezuela, Argentina, Lebanon, and other countries. Even in Turkey, we're seeing high inflation since recently. But more recently, people are speculating on inflation of the US dollar, especially on Twitter, and to be honest, mostly Bitcoin supporters often. I want to hear your thoughts on that. The question is, do you think we can see high inflation with the US dollar in the near term? And if so, why do you think that?
Well, I already see it, so I'll be the first one to call it out. There are lots of different ways. So, okay, starting from a scientific foundation as usual, there are lots of different ways of trying to measure inflation. And my colleagues in the econ area, the dismal science, have come up with various different schemes, but the implementation of those schemes is incredibly open to manipulation. The CPI has a lot of shortcomings. These days, for example, the CPI has to include in it things like calculators and computers. These things improve every year, and as they improve, then you have to apply a correction factor, because last year's basket included a whatever it is, some old machine, and now this year's has some much improved machine, etc. How do you compare them? I don't know how to do any of that. I don't think they know how to do any of it. It's hard. It's very, very hard. And but there are some things you can do, you and I can do. If you only were to look around, there's a very simple mechanism for comparing the cost of living and whether or not it's going up. So what are some of these things? I'll give you the simplest one. Take a look at a known quantity of work. Okay, take a look at known quantity of work, which is an end-to-end test. In computer networking, we love these things, the end-to-end tests that include everything in the test. So take a look at what it takes to hire an unskilled worker, let's say somebody who works at McDonald's, and see how many of them you get to apply for a job post listing at a given price point. I know what that was prior to the pandemic, and I know what it is now. I know that everybody is having a great difficult time trying to attract workers for that position. That already tells me that there is inflation happening, much higher than the 5% reported the CPI. And by the way, the CPI already has lots of much bigger questionable issues with it, like it doesn't include real estate and rent in it. So okay, so what am I saying at the end of the day? Well, I'm saying, look, I'm just a private citizen. My expertise is in distributed systems, but even as a private citizen, with just somebody who knows how to do basic math and how to observe things, I can easily observe that at least at the low end, if you run this simple end-to-end check, you see that the amount of money we were paying people to get a known unit of work done is no longer sufficient to get that known unit of work done. Will it go down? It doesn't look like it will. We've been at this for a while now, and lots of incentives have been offered. Those workers are not appearing out of the woodwork. So will we have to pay? Yes, it looks like we will. It looks like a lot of other people are doing the same thing. And will that cause inflation? Well, I think that's already happened. So my answer is quite simple. Inflation is always a worry. And these people who told you that, hey, the times are different now, we've figured things out, we've got this licked, etc. Those are the very same people who caused massive inflation in many different countries. Those are the same very serious people. Those are the exact same economists who were advising the IMF back in the 90s when Latin America was reeling under very high inflation. Very same people were advising countries to do what we call belt tightening during a recession, and causing these countries to go into even deeper recessions. So forgive me for not taking them very seriously, and forgive me for relying on my own faculties for observing these things. I can see that inflation is a worry everywhere around the globe, except maybe China, by the way. That's a different story. And I am very worried as a private citizen about the inflationary future to come.
Wow, thank you about that, Emin. I can only hope that somehow crypto can provide a solution for that, for even inflation of the US dollar. And I don't think we're there yet, but we'll see. Let's now switch the topics a little bit. I want to talk with you, Emin, about decentralized governance, because we've been talking about the currency level right now, but these currencies, they need to work on a protocol, and that protocol needs to be managed also in a decentralized way. But I do see some issues there with the systems that we have now. First of all, I want to talk about the token voting system. So most protocols that I've seen now use a system of single token voting, meaning that one token is one vote that you can make. However, that system to me seems like it's easily gameable. Like some company can buy a ton of tokens and suddenly they have a lot of more voting rights. Have you seen any more promising voting systems, DAO systems? Do you think there are better solutions out there?
Yes, I've seen some, and I've certainly come up with others. And so there's quadratic voting that a lot of people are excited about. There are, if you were to look at the internal memos at Avalanche, we've circulated various other ideas for exactly addressing this issue. But I also have to say, I would love to see mechanisms that are not single token voting. But I just haven't seen any that actually truly work. So it's always, the changing that is actually problematic and causes other problems down the line for the safety of the system, for the security of the system. It creates perverse incentives because people can structure their behavior. They can structure their, if instead of if you have a single coin voting system and I have, let's say, 1,000 coins and you have 100 and I have 10 times more votes than you, that's what it is. It has the drawbacks you mentioned. If you try to do anything else, then you will give me a reason to restructure my holdings, and I will always have more voice than you. And in fact, I might, in so doing, you might give me an even bigger voice in your voting system. So there are lots of issues there. I would love to see a good solution. I haven't seen one yet. That's my short answer to you. That's an open, unsolved problem.
Yeah, I think the same, really. I've seen some suggestions of other solutions, but I don't think we're there just yet. So I guess we'll have to see who comes out with the ideal solution. One more thing about DAOs, and this is a bit more of a philosophical questions that I have, and it's more of a thesis that I have myself. So when you think of traditional, let's say, startup companies have leadership that create a vision for the company, and then they have a team that executes on that vision. When the goals have been achieved, then they create a new vision and they innovate and they continue to build. However, I'm seeing some protocols or some solutions in crypto that are managed by a DAO. And I feel like because let's say the governing power of the product, of the protocol is now distributed, we're kind of, and this is a thesis, I might be wrong in this, I'd love to hear your opinion, but I feel like in some cases, we're kind of losing that innovation, that leadership of a central entity. Because there's not now many leaders, there's also not really one true leader that can do the innovation or a group of leaders. What do you think about that? Does that make sense to you?
Yeah, that's a common pattern, I think, is that when you have a single person leading it or a small group leading a project, they create a Schelling point, so to speak, a social Schelling point around which all decisions revolve. So when you switch to a DAO, you go from a small team to a DAO-based governance model, then suddenly the entire process can change. And now the people in charge, the people making the decisions are the token holders, and you don't know who they are. You don't know where they are. You don't know how they operate. There are no rules for how they get together and make decisions. And this can cause all sorts of issues. There's a very good essay called The Tyranny of Structurelessness. And it was written about the feminist movement in the late 60s, 70s, by a woman who observed that the feminist movement had a very nice feature, which is that it's decentralized, it's not organized, it's not explicitly organized, it's not hierarchically organized, but it's very, so the essay, it's worth reading for anybody who's interested in governance. And the essay makes the case that when you have situations like DAOs, where there's a mechanism, but there is no real decision-making structure associated with it, then you can run into situations where nobody knows how to navigate the system, or rather, most people don't know how to navigate the system. Some people do. Some people know where the token holders are. Some people know how to get them to vote, but most people don't. And so those people who do know the underlying dynamics that are implicit, that are hidden, that are not built into the system from the get-go, they are at a disadvantage. In fact, we can see this in crypto as well. Take a system with governance and take a system without explicit governance. So take the Bitcoin development process. There is no explicit governance. Nobody knows how Bitcoin will evolve, except, it will evolve, right? It changes over time. But how does it change? Who's in charge? Who do you petition? How do you do any of these things? It's very, very hard to navigate that for a newcomer. So if you have an idea that you think is going to be great, well, it's going to be really hard for you to convince people, because it's difficult to find the right set of people to convince. So the same is true of DAO managed protocols. They can, when you go to a DAO, they can become much more. The entire thing becomes much more amorphous, much more difficult to navigate. And in fact, what appears to be a decentralized DAO on the surface can end up being essentially a very rigid process managed by just a few people. Well, we've seen this with certain projects as well. It appears as if they are token driven, but in reality, just a small handful of people have enough tokens to block anything they don't like and to pass anything they do like. So it's really their own system, and you're just a bit player in those systems. So these are all issues when it comes to DAO governance, and they're really fundamental problems. And so there's a lot of work on voting theory to try to fix some of these issues. But again, it's a really difficult social problem to fix.
It is. It is. Okay, we'll see how that turns out. I believe I've mentioned that a couple of times already, but it really is like we're figuring out a lot of things right now on every layer. So yeah, again, I'm going to repeat it. We'll see how that goes. Let's dive into one layer deep, because we've talked about the currency layer, we've talked about the protocol layer. Now I want to talk about the blockchain layer, and I know you have a lot of valuable knowledge here. Let's start with the same question as I asked you in the beginning of our talk about currencies. Let's look 10, 20 years in the future, but now on blockchain layer. What do you see turning out? Do you see some kind of power law happening? One chain is going to be the majority. Let's say 80% of all transactions are going to happen on one chain. Or do you think is your vision of the future a multi-chain world, and why? What do you think?
Well, I think I can say yes to both sides of that question. So yes, the future is multi-coin for sure. I've said this many, many times. None of these systems die off. Okay, they'll be with us forever. Even the most useless ones, or even the dead ones. Everybody knows that there are coins out there where the devs gave up. They had a big fight and gave up. They did a rug pull and gave up. They deleted their social media and gave up. There's nothing happening for the coin, and yet there is still an item on the order books, and it has a price. These things get traded. They never die off and disappear. So that's a good starting point. What is important in these systems is growth. There will be some systems that are technically capable of absorbing the new value that's coming into blockchains. And those systems will grow. They will grow faster than others. And if you have a derivative that's faster than your competitors, then over time it compounds. This is the beauty of exponential growth. So some of these systems will grow to be much, much, much larger. Some of these systems, I think I alluded to Avalanche subnets, they have the right foundation to be able to branch out and accommodate more use cases than others. So they will grow much bigger, much faster, in my opinion, than others that lack the technical means to do so. So in the future, what's going to happen? Well, we'll always have Bitcoin. It'll be around. It'll be great. Time will tell if it succeeds at becoming the next digital gold. These other systems, there will be some of them. Some of them I see as very nice experimentation grounds. And then there are those systems that are actually fast enough, flexible enough to really absorb what I think will be coming on to blockchains, which is many hundreds of trillions of value that is currently not in digital form. So at Ava Labs, that's always been our vision, that we want to digitize everything. And I think the future is going to be with every single valuable asset traded and tradable on a blockchain, and that future is really, really fun. And that's where we're going to be, I think, in some time to come.
Right. If we imagine a multi-chain world, let's say I can't see a world where, let's say, it's multi-chain, and those chains wouldn't communicate with each other. So let's talk a little bit about bridges. I'm honestly a little bit skeptical about bridges, or at least the solutions we have now. But you can correct me if I'm wrong. Maybe I'm missing something. So the way I think about it, the bridges we have now, or at least the systems that I have seen, are mostly, I would say, centralized, or sometimes the companies behind them call them decentralized, but they still rely on a very small amount of validators of the bridge who can easily cooperate and still act as one central entity. And so that's why I'm a little bit skeptical about what we have now. Am I right in saying that, or are there fully decentralized bridges right now? And what's the future going to look like of bridges?
So, okay, so that's a great question. So here's what I think on the bridging front. We have a large number of systems, each with their own valuable assets. And it's now, this year, this coming next 12 months, it's going to be the war of bridges. Every single system out there is going to have their own bridging solution to try to tap into that value, to bring it onto their ecosystem, and to have their ecosystem grow faster than others. At Avalanche, we've been incredibly successful at this because we built the world's cheapest, fastest, most convenient bridge. And in reality, also, let me add this part as well. The distinctions between layer ones and layer twos, it's really immaterial. So they matter to people like me. They matter to a bunch of propeller heads that are really, incredibly deep into distributed systems. But at the end of the day, you have different systems connected by bridges. Let me also add this other thing, by the way. So there were, about 2 years ago or 3 years ago, it was really, really fashionable to talk about interoperability, and we ended up having a bunch of coins that came out and said, hey, we're the interoperable coin. And if you look at what they were suggesting, they're saying, hey, if you build everything using our system, then the things you built interoperate with each other. Well, that's true for the Avalanche sub as well, but we never pitched them as interoperability, because doing so would be A, dishonest because it's not really interoperable. B, doing so would betray that we don't even understand what the heck we're talking about. And every single other entity that I've seen do this interoperability thing, I just have great disdain for. They don't understand what they're doing, or if they do, then they're being dishonest. That's not how interoperability will work. Interoperability means you have disparate protocols that are being connected, and they're not using your protocol, and therefore you have to have a bridge to connect them. Layer twos use bridges. They use terrible bridges that tie up your money, that sit on it for 7 days or more at a time. So there's all sorts of issues with those. And layer ones are competing with each other in building a trustless bridge. Now, these bridges end up having huge amounts of value on them. You want the bridge to operate successfully. You want the bridge to operate well. You want the bridge to be not subject to any misbehavior. So how do you do this? Well, the thing that most people know about, so if I were to tell them, hey, I want to build something that is trustless, well, the thing they know about is how to build a smart contract. So they build a bridge using a smart contract. And that's okay. So, but the problem is you can only bridge to networks that support smart contracts. That's one problem. The second problem with this is those kinds of bridges tend to be very, very slow, because on one end you'll have to get multiple people to attest to things that happen on Ethereum, for example. We used to have an old bridge on Avalanche that worked like this. It was such a pain in the neck. It was a terrible, terrible piece of software. Lots of other competitors are using it. So there were many bugs in it that we had to patch, that we discovered. So I know some of the bugs might actually exist still, so we did inform them. So I'm hoping that they've been fixed. But ultimately, we abandoned that bridge. It just is not a good technology to do things this way. So so what other technologies are there? Well, I think the world was stuck. They didn't know about other things they could do to build a trustless bridge. So at Avalanche, we ended up building, or rather at Ava Labs, we ended up building a bridge using a different technology. So there's something called SGX from Intel that allows you to build a piece of software that is unmolestable. So that is, even the person operating that software is not in a position where they can change any bit of that code. If they change any bit of the code, then the hash of the software changes, and then the keys belonging to that software become invalidated. So that is, it's kind of like, if you were to try to hack a game, well, then suddenly the game has a different hash. So games are not protected by the software. And if they were, you would find that patching your game to give yourself superpowers, etc., would be rejected by the underlying hardware. So our bridge for Avalanche is protected by SGX. We are the first first company to bring this innovation to the world. We, I believe, have the highest value SGX application. We've been in talks with Intel about this recently, and so I'm really proud of the technology that we built on that front. Most other people don't even know it exists, and here we are. We already deployed it, and that's how the Ethereum to Avalanche bridge is so cheap, and its entire architecture is designed such that the bridge itself is not something you interact with. Nobody knows its IP address, etc., etc. So it's got a lot of great security features, and it works in a way that is unmolestable and protected. So. But you are right. There are, like, many of the bridge designs end up having to rely on a small number of bridge operators. And I'll be the first one to mention that the Ethereum to Avalanche bridge at the moment, as of this very second, does divide up its super secret key and hand that key out to, I think it's about 4 wardens. We're about to change that number to a larger number very soon. But there are 4 wardens out there who are holding pieces of that key. So we did that because this is new technology, and things can happen. There might be a bug in the bridge, and you can get into a situation where the funds are stuck. And if that does happen, you want to be able to rescue the funds. So you do need to have remedial measures, especially when you venture out into new territory. That's the current implementation at the moment. These wardens operating together in conjunction, all 4 of them could reconstitute the bridge secret. But that's much, much better than most other bridge not most, every other bridge technology out there. So it's cheap, it's fast. I encourage everybody to try the Avalanche bridge. It's really beautiful to use, it's elegant, and the whole process is really simple. That's why I think we found that the money that comes over the bridge tends to stay in Avalanche, and that's how we are able to do things like, it's actually cheaper to, instead of doing DeFi on Ethereum, it's cheaper to transfer the funds to Avalanche, do the exact same operation on Avalanche, on the C chain, using the equivalents. You can still use Aave on Avalanche instead of Aave on Ethereum, and then take the results back to Ethereum if you like. But you'll probably stay, because once you use Avalanche, it's really hard to go back. Once you get used to fast finality, once you get used to this whole bridging operation, it's just so convenient to use. But the end point here is, yes, it's going to be a war of bridges. Those people with the best ones will end up attracting the most value and the biggest user community. Come check ours out. We're very proud of it. I'm very proud of it, and we're at the forefront of tech development, not just on the platform side, but also on the bridge side. And there's been there are many other cool ideas to come from Ava Labs. So we love to sort of advance the state of the art when it comes to blockchain science.
Amazing, Emin. Thank you so much for that. Our time is almost up. I have one last question, Emin, and I want you to challenge us at Reserve a little bit. Because for various reasons, our current idea to deal with the scalability issue. So we're built on Ethereum, and our current idea to build on to solve the scalability issues is to build on an L2, something like Arbitrum, Optimism, or ZK Sync. Please challenge us from your perspective. What is what are the downsides of using an L2 versus an L1 like Avalanche? What are the main arguments why it would be better for us to start an Avalanche?
Okay, so last question is a topic that's going to potentially take another hour. But let me very quickly talk about layer ones versus layer twos. Layer ones are great, and I think everybody listening to me right now has had at least some experience with one layer one. And doing DeFi on a layer one is it is what it is, depending on what your layer one is, right? On Avalanche, it's nice and convenient and super fast. It's as if you're dealing with regular old web services, but really you're dealing with a very fast, very decentralized network. So layer twos are their own beast. So when your scalability roadmap involves building a layer two, what you're really doing is you're attaching, as I mentioned before, something like you're trying to attach something like a jet engine onto a car. And now what's going to happen is instead of just having a car that everybody recognizes and uses, you end up having a bunch of cars with a bunch of weird strapped jet engines on top, and they don't talk the same language. You end up fracturing your liquidity. You end up fracturing your contracts, your components. They don't interoperate. They do not compose. So if Reserve is using, let's say, Arbitrum, then it doesn't communicate with the contracts that are not on Arbitrum. And what is Arbitrum? Arbitrum is just, well, whatever. It is what it is, a layer two solution. So let me not go into that trend. But let me just first point out, these things are a bad way to go. From a technical perspective, they divvy up your entire space because they don't compose. We all came to these systems. We were all attracted to these systems because they provided a flat democratic space for all of us to interact with our favorite services without any kind of interference. Layer twos, depending on which one you guys use, take that away. The person operating the layer two is in a prime position to take advantage of MEV, depending on what the layer two is doing, to censor certain transactions, again, depending on how the layer two is structured. And that flatness, that accessibility is gone. What attracted me to this space is gone. Are layer twos going to be important? Yeah, they're important if you have run out of ideas on how to scale. If you don't know what to do, then that's what you run to. Every dev group that has run out of ideas just goes and jumps onto a layer two bandwagon. So that's what I think I see when I look at that space. Now, there are other issues with certain layer twos that are completely unsolved. Like some of these that you mentioned have data availability problems. So Optimism was very, very, very popular a while ago, a couple months ago, which is an eon ago. Now everyone's talking about Arbitrum these days. This changes every 2 years, every 2 months, every 3 months. So you're going to end up picking something and committing to something only to find out that 3 months down the line, people have shifted their attention to something else with slightly better features. That's a huge problem to me. And be careful about the ones that you pick, the Optimism and Arbitrum that I mentioned. These things have availability problems. So the data that's, that you're supposed to, so the story goes, you use a layer 2, and if the layer 2 misbehaves, then you end up having this challenge process. Well, what are you going to challenge? How are you going to process those challenges? How are you going to construct those fraud proofs on a system where underlying transactions are so expensive, where the data was not available to the system in the first place? That's the entire point of a layer 2, is to take transactions away, to not have the load be incident on the underlying platform. It has a lot of data of its own. It has a whole history of transactions that the layer 2 processed that the layer 1 never saw. And now you're saying, hey, there was a problem. I got cheated out of some money. Well, okay, how are you going to go and prove this? You have to somehow go through a massive portion of the transactions that actually happened in that layer 2. And that data may not be available to you. And this is a really big problem for many of the layer 2s out there. The ZKP-based ones, the zero-knowledge ones, try to solve this. But then they have the problem that generating one of their zero-knowledge proofs takes about 8 to 12 hours of really hard work. So now you've got another problem, which is, okay, well, you came into this universe, and taking money out requires a very, very complicated proof. So overall, what am I left with? I'm left with a vision that somehow these things could work. And can you strap a jet engine on top of a car? Yeah, you can. Why not? Right? You just weld it on. And do you get something elegant as a result? No, that thing's going to steer like a crazy thing. So that's exactly what we find with layer twos. You can strap them on all you like. What people really came to the space for was flat, easy access, democratic access, blockchain as a rendezvous point for everybody, as a single rendezvous point, as opposed to this complicated structure, this Rube Goldberg machines that people are trying to build. To me, this signals a lack of ideas, a lack of means to evolve the layer one. And it's an indication that layer one is not going anywhere, is not going to be able to deliver scale and speed. And yeah, I like the layer two solutions, but I just don't see them as permanent or even desirable in any shape or form.
Wow, Emin, this talk was absolutely amazing. I personally learned a lot, and I hope it's the same for the audience here. If anyone here in the audience didn't catch part of this talk, we're going to upload the recording to our YouTube channel, the Reserve YouTube channel, where you can re-listen to it. And that should be up in the next couple of days. Well, Emin, again, thank you so much for this incredible talk. I wish you all the best of luck with Ava Labs and whatever you do. Thanks again, and best of luck.